As the first speaker, we have Patrick Honohan, who is an honorary professor at Trinity College in Dublin and at CEPR. And he will then be interviewed or further challenged by Richard Portes after the presentation by Patrick. Patrick, without further ado, the stage is yours.
Thank you very much. So it's been a bit of a shock, this inflation. Richard and myself remember the last great one, but there you are, 20-something years of inflation, and it's only in the last few months that we've seen this huge spike. It's not just here, it's not just in Europe, it's not just in the USA. That's, I think it's 35 countries. You see the median is higher than the median. Think about it, that's right. We can't have Turkey in a group of countries without the mean going above the median. Jean-Claude Trichet wasn't far from a general consensus with his mantra, we have only one needle in our compass, price stability. But now, at most central banks, the needle has gone haywire. The more independent the central bank, the more their mandate focused on price stability. But now their targets have been badly missed. And along with inflation, central banks have come into the crossfire of public debate. There's the searches for the Bank of England, quite high around the financial crisis and quite high recently for a number of reasons. But one of the reasons, inflation, and you can see the searches for inflation just led that search for the Bank of England. So what? Who cares if people talk about central banks? Well, that's what Montague Norman used to brush off criticism 100 years ago with the desert aphorism, the dogs bark but the caravan moves on. Never excuse, never explain. That was his maxim. But that won't do today. If a central bank is to be effective in a time of elevated uncertainty, it's got to be understood and trusted. What's it doing? Why is it doing that? Its analysis and its policy choices need to command respect, or else market participants will not take any kind of forward guidance, explicit or implicit, seriously. What's more, if it's not to become hedged around with legislative restrictions that hamper its ability to fulfill its main role, the central bank needs to retain the trust of the general public. Its concern to minimize adverse side effects of the measures it introduces need to be evident from its actions and how they are explained. And there's a lot of explaining to do. Why did the sudden inflation happen? To what extent is it the fault of central banks? Can central banks bring inflation back under control? And how fast should they do it if they can? And what's the best end point? Would 3% be a better target than 2% for the medium term? Why are central banks suddenly losing money? And does it matter? And then when they step in, as they have, to stabilize financial markets in this inflationary environment, in whose interest are they doing it? Cui bono? And more generally, is monetary tightening hitting the poor more than the rich? Should central banks care about this? Should they remain exclusively focused on price stability? The ability of central banks to answer these questions and answer them convincingly will determine whether they can avoid intrusions into their independence, much prized, operationally essential. So let me give a few hints about what central banks are worrying about and trying to analyze and trying to communicate about under those headings. So why the inflation? Very quickly, I think everybody in the room recognizes the various factors that have been relevant here. It's arguably the most complex macroeconomic event of recent times. A lot of it has to do with energy prices, and but only some of that comes from the behavior of Russia. A lot has to do with the disruption of global production and trade, which was the engine of 3 previous decades of low inflation, and a lot with the fiscal and monetary reaction to the pandemic. Now, here's a couple of nice charts. This is the first of them, which my friend and compatriot Philip Lane posted last week, so they're up to date and they're quite instructive. They're for the euro area. I'll come to the UK and US. The first one shows the relative movement, it's not the absolute movement, the relative movement in the different components of the inflation series in the euro area before, that's the left-hand side, and then after the outbreak of the pandemic. And it shows the importance of the trend relative decline in manufacturers, and that has continued into the pandemic period, and the predominant importance of energy inflation, especially since the autumn of 2021. That's a very important thing to bear in mind about this thing. I know we see inflation everywhere, but the importance as a driver of that energy movement. Why did energy prices increase by so much more than others? Lots of analysis going on this, and this is an interesting chart. This is the second of the Philip Lane charts that I wanted to draw your attention to. And it shows, okay, it's the result of an elaborate analysis, but it shows the contribution of supply and demand factors to the energy price movements during the pandemic. And you can see that demand and risk factors caused the energy prices to fall in the first part of the pandemic. But in this recent inflationary part, it's all supply. The dominance of supply shocks since mid-2021 is evident. That's really important to bear in mind, and it's to bear in mind for central banks in reacting to this situation. Now, there are different ways of looking at this whole problem, and I'll show you just one more chart. Details do differ if we look at the UK and the US. So, for example, look at this. It's a completely different way of breaking it down and analysing. It's a decomposition recently proposed by Larry Ball and co-authors. And there you can see that it assigns almost half of the 5 percentage point rise in the US inflation over the past 21 months to the tightening of unemployment conditions. That's the second one on the left there, V over U, reflecting demand conditions. So here in the United States, you can see a more importance of demand conditions, as well as the slow return of workers to the labour market. And look there also at the role of rising inflation expectations. It's on the left-hand side, not so big so far, but could come more. And supply disruptions, as the backlogs of work there towards the right-hand side and the auto prices. It's complicated. Clearly, central banks need to fully understand what's been going on in this complex environment and to communicate this to relevant economic actors. And the contribution of monetary policy? Is the inflation an inevitable consequence of the huge expansion of central bank balance sheets in the previous decade, as many superficial observers say? That's a question they have to answer very, very clearly. For me, probably not. Though if there had not been that pool of liquidity, the price rises might have been slowed a bit more quickly, quasi-automatically, by the liquidity squeeze. I'll grant you that. Arguably more important than the pool of excess liquidity has been the pent-up demand from the huge pool of excess savings that accumulated in the pandemic. In other rooms, I'd have to explain why I'm making a distinction, but I think you understand here. That savings would have been smaller had governments paid for some of the spending they made for income support, which was needed. But if they had paid for it by, for example, a pandemic income tax surcharge. So from this perspective, fiscal bears more of a burden than monetary in that balance. Okay, how are central banks responding? Okay, there was some room for catch-up inflation to compensate for the undershoot of the target in recent years. So I had a look to see how much undershoot was and how much inflation. Well, here's the UK. And yes, so the compensation has been, well, it's been the undershoot, whatever there wasn't that much undershoot of the target of 2%, has been well overcompensated by now. Though not in the US or the Euro area, if we start the ball rolling at a suitable date far enough back, such as September 2008. There's Euro area consumer prices right up to the last observation, I think October. And you see if you start in September 2008, inflation has not actually caught up with where Jean-Claude Trichet would have wanted it to be if it had grown at 2% per annum. How about that? Big surprise. But you have to choose your date carefully. Choose another date like somewhere in the middle of, I can't remember where I chose, somewhere in 2013, 2014. Will central banks try to get back onto, well, whichever of these paths, these original price level target paths? Remind you that there have been recent revisions to the monetary policy strategy by several leading central banks, emphasizing averaging of the inflation target over a period of time. So the Federal Reserve did that, the ECB did that, but still, most of them still think in terms of a forward-looking inflation target and not a price level target. There was some discussion of catch-up inflation to compensate for overshoot, but a wide expectation that this would not be symmetric. And indeed, that's what's happened. Let me move on. How much tightening is needed? If I had a vote, you'd be listening very carefully. If I still had a vote, you'd be listening very carefully to what I have to say about this. Obviously, Taylor rule is your first port of call for understanding central bank response to inflation and output fluctuations. Many versions of the Taylor rule, they all start from the concept of a neutral real interest rate, R star, which inflation is at the target level, output employment at full potential. And according to the Taylor rule, you all know this, central banks should set the short-term nominal interest rates higher than when inflation or output exceeds their target level. Everybody agrees with that. But the problem is, you can say, okay, just plug it in, just do it and go home. The problem is that there are many versions of Taylor and details matter. They matter especially at the moment. So what inflation rate should we use in the formula? Should it be the last 12 months? Market forecasts for the next 12 months? Or for the next 12 years? 3 years? Or what? That's what the market thinks inflation is going to be over the next 3 years. This is also very recent. Okay, the expectations are they are changing, but so the current expectation is that not many people think it's going to be less than 2%, but not many people think it's going to be much more than 2%. That's market participants. But what about household forecasts? Household forecasts. There's so many households think it's going to be more than 3%. There was another, this is the latest version of this came out this morning. That's not it, but it's not much different. Households always more pessimistic about inflation than market participants. And by the way, older households, much more pessimistic than younger households, maybe because they can remember something before. Okay, so that they all differ by a lot. So what do you plug into the formula? Where is R star now? R star was getting lower and lower and lower. And sure enough, there is a downward trend, but look at the x-axis here. This is over hundreds of years, a downward trend. Okay, but the last downward trend we looked at is over here on the right-hand side, the blue line going in a jagged way right down to below zero. Is that part of the long-term trend, or is that going to reverse itself again and the trend is shallower? We don't really know. Well, anyway, compared to current inflation, over the past year at about 10%, I have to admit that the ECB's 2% policy interest rate, or 1.5%, depending which one you use, actually kind of looks ludicrously low when you take that perspective. But not so much compared to those market expectations around 2%, especially if R star is indeed negative. So it's quite difficult to judge how much more interest rate increases would be necessary, for example, in the euro area. After all, raising interest rates sharply when recession looms is not what Taylor said. With local variations, every central bank is weighing these judgments. It's a tricky message to convey, even if you've got the answer right. And where will the end game be? One silver lining of all this inflation is that inflation has gone so high now that there is a chance for the main central banks to reset the global reference point for price stability from its current somewhat arbitrary value of 2%. With R star much lower than it was 30 years ago, that's for sure, most economists realize that a 2% inflation target is too low to provide enough policy room for combating a recession. Now, shifting the consensus target from 2% is hard, but it's not as hard as it was before this inflation. The overshoot has offered an opportunity to reset that consensus at a much preferable 3%. Now, you may think, don't give me all this stuff. I want to get inflation down now. But it's worth thinking about where are we going to end up? 3% better than 2%. Side effects. I don't have that much time, although I think the clock was started a little earlier than I started. But anyway, side effects. I want to give you 3 side effects. Central bank losses. This is an intriguing side effect to the abrupt changes in bond and other asset prices over the past year or so, at risks bringing central banks into disrepute. And it's the financial losses that have occurred, that have resulted for central banks. Different in size, depending on exactly the position of central banks, not many have lost. Maybe nobody has lost as much as the Swiss National Bank. This year looks as if they're going to lose an amount equivalent to 17% of Swiss GDP in 1 year. Good. But many other central banks are strongly affected. Reserve Bank of Australia, it's reported not only an annual loss, but a negative equity position of about 1% of its latest year end. Headlines like that. The Federal Reserve, its baseline expectation is to make net losses for several years. And actually, this might be considered odd because higher interest rates have traditionally been good for the profitability of central banks. I think you know why this has happened. After a decade of QE, the greatly expanded central bank's balance sheets have accumulated a big maturity mismatch. Most liabilities paying short-term interest rates, most of the long-term assets are yielding rather low coupons set during the long years at the effective lower bound. The Bundesbank and the Netherlands Bank are among the first of the central banks to acknowledge the impact on their net income. Let's see. It's a bit of a blame game here. ECB is tightening monetary policy. Netherlands Bank accepts no responsibility for that, obviously. Both have been making sizable provisions for likely annual losses. They won't be transferring remittances to their governments, and the Netherlands Bank warns that it too may move into a negative equity position. Bank of England, we're in London, has published projections. It doesn't go bust because it has a range that the Treasury provides anything that it loses. How much is the Treasury going to have to pay it over the coming decade or so for net cash outflows? Bank of England is talking about £230 billion, or 10% of 1 year's GDP. And that could be almost double if interest rates are about 100 basis points higher than in the base projection. So this all looks like serious money. Was it wise for central banks to expose themselves to such losses? Well, there were benefits to the consolidated accounts of the government and the central bank, so to some extent balancing out. But, well, you know why. QE shortened the average debt maturity of the consolidated public sector, and this was inherent and deliberate in the policy designed to flatten the yield curve when short rates couldn't be pushed any lower. But we didn't expect this offset. Nobody expected the sudden rise in interest rates. It was there as a possibility, but nobody expected so soon and so sharp. So these movements have been much sharper than anticipated, far in the tail of market-implied probability distributions, as consequences for the fiscal position, for issues of wealth distribution, for the financial independence of central banks. Does it matter much if central banks are working with negative equity? Academics tend to be much more relaxed about this than practitioners. There is actually some academic evidence that central banks with weak balance sheets tend to operate less effective policies. They tend to have higher inflation rates or to have resource to quasi-taxes, like unremunerated reserve requirements. And the financial independence of the central bank with negative equity can be questioned. On the other hand, the Bank of Israel, Czech National Bank, Central Bank of Chile, and a few others are examples of central banks that have operated a reasonably successful monetary policy for many years while in a negative equity position. Second side effect, when it comes to financial instability, interest rates going up, recession appears, and bailouts. The politics of central bank actions to avoid financial instability are fraught. They can be framed as bailouts, and the direct beneficiaries can be identified as established segments of the financial sector. Central banks have been dogged by accusations that they bailed out the bankers in the global financial crisis at the expense of the little person. The speed and extent of the rise of the US Tea Party in the United States is attributed by many to this inaccurate narrative. And sharp price movements in the past year have triggered central bank action to stabilize dysfunctional markets, but in doing so, they have been seen as bailing out large financial and quasi-financial firms or markets. There was the dash for cash early, but let me not say anything about that. But the much smaller but still dramatic intervention by the Bank of England in the market for UK government bonds in October, in other words, last month, 2 months ago, had a similar motivation. And you know the story there. Here, too, the Bank of England decided to stabilize an important asset price. And since the most conspicuous beneficiaries in this case were pension funds, the political criticism was muted. And we saw similar actions in Sweden and other countries for energy companies. But where is the line to be drawn? If further sudden losses hitting major financial or utility companies seem imminent, will the central banks bail out again? Is the yield on long-term government bonds to be anchored by central banks, as it is in Japan? If so, at what level? It's not just the issue of moral hazard, but also the perception, the public perception of selectively bailing out some big financial firms from the consequences of a generally felt rising inflation. The appeal to financial stability is often uncomfortably vague and unrestricted. And in some countries, including the US and Sweden, the powers of central banks have been limited, the powers to act in ways that are vulnerable to these kinds of populist critiques. But if you restrict central banks from doing things that can become essential in an emergency, the consequences for the general public in the next crisis could be severe. So here too is a communications challenge. Actually, the Bank of England didn't do too badly in communicating around that LDI event in October. Last point, inequality. There are wider distributional issues regarding monetary policy and its efforts to bring back inflation under control, and not just on left-leaning Twitter accounts. Central bankers have become sensitized to this issue. Look at all the central banks now mentioning inequality in the speeches. A proportion of speeches, 8% of central bankers' speeches nowadays mentioning inequality. And of course, the post-crisis decade of high bond prices gave rise to accusations from the left that central banks were, with their expansionary policies, enriching the wealthy while the rest of the economy stagnated or recovered only slowly. And now, of course, the cycle has turned. Interest rates are up, bond prices down. But hasn't monetary tightening usually been seen as bad for lower income groups and good for the rich? Indeed, that's what econometric studies seem to show. There's just one chart from many studies that show that interest rates go up. More prosperous people have an increase in their income share. So anything the central bank does seems to be bad for the poor. That can't be right. It's not an unresolvable paradox. My time is out, and so I won't explain why. Very easy to explain it, but it's a big communications challenge. I have a paragraph which explains it. I don't have time to give it, but it won't be enough. A paragraph won't be enough to convince the general public. I'll leave it at that. I think we have moved beyond Montague Norman. I think we need the skills. I think Maynard Keynes mightn't even be able to manage what the central banks need to do now. Thank you.